Today we're going to look at two things: the average true range and a trading strategy. The average true range is one of the standard indicators that's readily available. Now the reason I'm saying that, or looking at this, is because this is how much, in this case, the DAX typically moves in a day. And that's a handy thing, because then you kind of know, okay, if I say bought it at the start of the day at 11,600, then, well, if it moves up to 11,800, that would be a typical daily move. So you might want to get out at that stage, or you could use that 200 as your stop loss, to keep that in mind. Now if you zoom back a bit, we can see some patterns. So I'd immediately go, this seems to be higher highs and higher lows, and if you could nearly draw a line connecting this low, and this low, which would suggest that the true range is going to start increasing again. That's one of the problems, that our brains are pattern finders, so we see patterns all over the place, even though that doesn't actually necessarily mean anything. If you zoom back even further, there's an odd pattern. The range seems to be in an uptrend. Now I would go, well, if you go back here, the DAX was about 8,000 and now it's approaching 12,000. So your base index has gone up by 50%. So even if the randomness was the same, we'd expect the average true range to be increasing as well. If it's using our log normal models, where the percentage change of the current value that's normally distributed. So just introducing the average true range. Now do with that what you will. In a way it's tempting to go that these highs and lows mean something. So this low for the average true range is a high on the DAX. The DAX fell. Over here, the DAX was here, but then it fell down to that low, and those ends were marked by ends for the average true range as well. Unfortunately, that pattern doesn't really seem. It's not incredibly reliable. I mean, a lot of the times the peaks do map up, but a lot of the times they don't. So what I mean there is, if I looked at a couple of examples and I'd go, oh, the top and the bottom for the average true range is a signal for a turn in direction for the actual DAX, and then I could go, well, I can imagine that this is a low for the average true range, because the lows seem to be increasing and so on. So if this is the low, and that's a good indicator, if it was a good indicator for a change about to happen, then I'd be tempted to go sell this. You know, that the average true range is telling me or suggesting that this might change direction, and that tends to equate to a change in direction in the DAX as well. But that, you know, that's the kind of a potential theory, but as I said, I'm not particularly convinced by that. A lot of the time I'm seeing highs here which don't equate to changing directions in I see highs and lows for the average true range which don't map to changes in the actual DAX. But there might be something there. So just mainly wanted to talk about one thing. So nearly done. I'm going to switch to hollow candles. Yeah, just because then I can see, I like the brown line, and if it's hollow I can kind of see what the level is, because a lot of the green candles have now become transparent. Well, we can't see it that clearly. Yeah, see now, as we zoom in, with the hollow candles I can actually see the brown line. So what I wanted to finish up with was, if I zoom out, really look for a big picture, and in a way I'm trying to decide what I want to, what my trading position is. It is basically I'm long, and I'm just using the very simple one of, if I'm above the brown line, then we're in an uptrend, so I want to be long, and if we're below the brown line, we're in a downtrend. That works better if you're talking about long time periods. So if I look at the 20-month moving average, we're above that, and that to me is an uptrend. And this we can zoom back. I don't really need the average true range at the moment, so get rid of it. Now we zoom back. So what I want to do here is look to persuade you that the brown line, you know, if you're above the brown, then it's long, and if it's below the brown, it's short. Does make some sense. Well, firstly, the general trend is up. You know, we started way back here, and it's just been increasing. So, you know, in general, you want to be long. Then if you look at that brown line algorithm, you know, I'd get long here because we're above the brown line, and I'd hold on, and I'd only sell it once it broke, when it was below the brown line. So here it did touch it, and we'd exit our position. But remember, we bought it way back here, so we made some nice profit. So this was at 2,000, and we would only have sold it at 4,450. So more than double. There's a bit of jumping up and down here. So, you know, we'd go short as it went down, but then maybe zoom in a bit more. It's very choppy here, so you'd have to kind of figure out, do I want to filter somehow? Will I only buy it when at the end, do I only buy it on a monthly basis? I don't know. So, you know, during this period, during this year or two, so again, we're talking about long time frames when you're looking at monthly candles. This brown line is crossed all the time, so it is very choppy. It finally breaks away here, so now you'd want to be long. So you would have maybe gotten out at about, you'd maybe gotten in at 5,500. That's being very harsh, because I mean that's highly above the brown line. But since, you know, this period is very choppy, so this strategy, if you were just automatically buying and selling based on when it was crossing the brown line, it would be very probably loss making, because you'd be losing, when you'd be paying some margin either way and so on. But so even if you bought it 5,500, then you would have sold it at 6,400 ish. But you know, you'd again have made a nice bit of money there. Though you wouldn't have sold it at the top. So you know that's something, you know, you've got to have accepted. That, you know, I'm not gonna be calling the top, but I would have made good money.